and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by Tom Becket, Chief Investment Officer for Psigma. Hi Tom.
Hi Emma.
So life post-Brexit doesn't seem to be what Project Fear has threatened us with. You know, the FTSE has rallied considerably and economic growth looks like it may be on track for a 1% GDP expansion next year. So have we dodged the Brexit bullet?
I think it's important you separate the conversation out into two separate parts because there are very different forces at work. I mean, I think let's think about the market reaction first because markets move much more quickly than an economy, certainly, or that's been my experience of the last dozen years. I mean, in terms of the first big shift we saw, that was obviously in the currency, and I think on a trade-weighted basis, the sterling has fallen by about 12% since June 24th, when the decision to leave the EU first came about after the referendum. So obviously that's had a positive translative effect upon UK corporate earnings, given most of the companies' earnings in the UK are derived overseas. So we've seen a shift higher in the FTSE 100 in particular, but actually more recently there's been a catch-up trade from lots of domestic companies as well. So I think first of all talk about the international side of things. Clearly there's been an improvement in earnings there, which has been translated into better stock performance. And the domestic side I think is probably second guessing to a certain extent your question about the economy. Are things next year going to be less bad, in inverted commas, than people were first forecasting after the Brexit news came through? I think it's far too early to tell, I think, in all honesty. I think some of the data we've seen so far has been somewhat ambiguous. So certainly on one side we've seen a situation whereby business confidence has fallen. On the flip side, things like retail sales hold up quite well. Now whether that's because the sun is shining outside remains to be seen. I think with regards to the economic understanding and the answers to the questions you've got, let's wait until we get into the start of 2017. My view is still for really quite low growth in the UK as we head into 2017 and the possibility perhaps of a technical recession.
And that too early to tell accusation is one that was levied at the Bank of England with its QE programme. The fact that we are committed to buying £70 billion worth of bonds and indeed, you know, lowering interest rates even further, perhaps down to 0.1% next month. Do you think they acted too soon? And indeed, as you say, you know, the truth is yet to out.
I mean, I think actually it was just positive to see Mark Carney finally do something and earn the millions of pounds that we're paying him to look after the Bank of England. I mean, let's just take the three things that they announced in isolation and then put them back together, what it means for the UK economy. First of all, with regards to interest rates, I think they're pushing on a piece of string, to quote Mr. Keynes. I can't see that that's going to have any positive effect whatsoever. And actually, for choice, I would say that lowering interest rates has a negative effect upon the economy because I think we've gone past the point of equilibrium where it continues to be a positive. Secondly, with regards to the quantitative easing programme, I mean, okay, but I've seen no evidence from the last decade or the last 9 years we've been trying such policies that it's really worked that well anyway. So I'm sceptical of that, and I think actually it's just made expensive investments yet more expensive and brought forward future returns into the now for stressed investors. I think finally, with regards to what's been titled the Funding for Lending Scheme 2, okay, fine, let's try and encourage the banks to lend, but I think the penalties for not lending are less penal than the first announcement of funding for lending from a few years ago. And I think the second point to take into account is banks are awash with liquidity. Liquidity is not the problem. Banks have got money to lend. They can't lend it to the people they want to lend it to because they don't want to borrow. So I don't think that's necessarily going to help. So I think I'm afraid to say that monetary policy's ability to shelve off the worst or you know, put off the worst forms of economic regression, I think are somewhat limited, and I don't think that's going to be a huge factor as we head into next year.
So heading into next year then, with that uncertainty still around, as we do not know the true impact of Brexit, and perhaps central bank policy is not effective, what does this actually mean for investors?
I think it makes it a very difficult environment to invest because, you know, if you think back to previous episodes when you had expensive equity markets, at least you could go into fixed interest investments and still achieve a return. Now that's impossible. And I've just come from our latest investment committee meeting, and I was questioned on my views that equity markets around the world strike me as being expensive for low rates of earnings growth. But as people quite rightly question, whereabouts are you going to put the money? You can only have a certain amount in emerging market equities or emerging market debt which look attractive, or elements of high yield corporate credit look attractive. You know, really equities are going to remain a high weighting in people's portfolios because of the paucity of options elsewhere. So I can sit here and tell everyone that equity markets are expensive till I'm blue in the face, but as we've seen from the last couple of months, in particular an acceleration post-Brexit, because of the fall we've seen in government bond yields, I think equity markets can continue to defy gravity, and I think that the whole concept of equities investment almost has to be turned on its head, because I think people are now looking at equities less as equities and for their growth, for more actually like corporate bonds because of the income you can get. So effectively corporate bonds have now, equities have now become almost corporate bonds, but certainly a spread product. How much extra yield can I achieve over cash deposits and indeed government securities?
Tom, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.